Should be good.
All right. Welcome, everyone, and thank you for joining today's Hotel Investor Marketplace webcast, produced by Hotel Brokers International. I'm Tony DeGeorge, President of HBI and President of Green Canfield DeGeorge LLC. I appreciate you joining us today to hear our speaker discuss turning a 1031 exchange into a 1031 plus. While everyone is getting settled in and comfortable, I'll share a few things with our audience. HBI was founded in 1959 and is the leading network of real estate brokers specializing exclusively in hotel real estate investments, providing every phase of brokerage from property evaluation to the closing. Please visit HBI on the web page at hbihotels.com. If at any time during the webcast you have a question, just click on the Ask a Question button located at the top of the webcast player. Type in your question and submit it. We'll answer as many as we can as time allows. We've also included some attachments and links under the attachment button. The attachments will be throughout today on the webinar, as well as later today when we record the event and post it on demand viewing on hbihotels.com. We want to let you know, please let us know how we're doing. There's a rate button at the top of the webcast player, and we'd certainly like to hear your comments. Please feel free to share this webcast by clicking Share This button also on the webcast player. Now I'd like to welcome our speaker, Jon Dauble. Jon is a partner in the firm of Dauble Wilson Worthington LLC, located in Evansville, Indiana. The firm specializes in delivering institutional tax and wealth strategy to those in the highest tax brackets, as well as those in significant estate tax liabilities. Welcome, Jon.
Thank you, Tony. Thanks for the introduction, and Sherry, too. Thanks for all your help getting this put together. I'd like to thank everybody else for spending a few minutes with us here to hear what I hope is a really exciting and new concept for you. We've taken an old concept, the 1031 exchange, and put it on steroids, and I think you'll find it at least interesting and hopefully helpful to your corporations. Let me start by just giving a brief overview of who we are. We are a tax mitigation and asset management company. So we run about 9 different tax mitigation strategies. The one we're going to talk about today is just one of them. We are not hotel experts. We are not even real estate experts. But we work with some of the best people in tax planning on deferral of paying taxes in the country. We've been at this, I've personally been at this for about 40 years now. We started Dauble Wilson Worthington in the last year and a half due to being able to develop some relationships with some outside firms in order to accomplish what we want for clients. Besides the tax mitigation for corporations and highly compensated individuals, we do asset management, non-reportable income planning, 831B small captive insurance solutions, which is a really hot item right now for a way to increase assets and reduce taxes, and then multiple other types of asset protection strategies. We are located kind of in the heartland of the country, out in Evansville, Indiana, which is an odd place to find a firm like us, but it's home, so that's where we started and decided to stay at. Again, as I mentioned, I've been doing this for about 40 years. I first really came into develop a love for tax mitigation back in the early 90s when I was working with one of the founders of one of the big box companies. He had quite a bit of stock in his own company. His cost basis was about 3 cents a share. The stock was selling for between $30 and $33 a share at the time, and we were able to liquidate all of his stock and give him a 7-fold increase in income without any negative tax liability. That's simply by using what the tax code gives us and knowing how to structure it correctly. It's nothing more than that. There's no magic to it. There's nothing out of bounds. It's just simply understanding how the tax code works. So what we're going to do today is talk specifically about what we call a 1031 plus. And so we're going to compare it to just a traditional 1031. This is also called a monetized 453. And just so that everybody starts out on the same page, on a 1031 exchange, as long as you follow the rules, and one of the rules say that you have to have like-kind property. You have to identify your property within 45 days. You have to close within 180 days. Again, you have to have like-kind property, even though most of us use a little bit broader definition of that. If you go back and read the law, it's real estate to real estate, art to art. Even if you're dealing with livestock, you have to use same-sex livestock. You also have to have equal indebtedness to maintain the exchange. And if you follow all of these rules, you can perpetually defer your capital gains on any sold property. What we do is we have found a way to structure basically the same thing and eliminate the negatives. So your 45-day identification period is eliminated. Your 180-day close is eliminated. The like-kind property is completely eliminated. There is no equal indebtedness. And in addition to that, besides being able to perpetually defer your capital gains, and we only do this on a 30-year period with the ability to continue that by signing a new contract every 30 years. And we give the clients approximately 93.5% of the proceeds up front for any business use, and that's a very broad definition. There's no time frame, again, for the reinvestment of your proceeds. The other thing that we think is a huge plus is that when you're doing a 1031 plus, you are allowed to start your depreciation over again with a fresh depreciation schedule, and that is a real plus when you sit down and you look at your return on investment.
And John, not to interrupt you, I know you have some slides, and I just wanted to make sure that we sort of keep up with you on the slides. If you'll look at the player and see if we're close to where we should be.
Okay, let me. Okay, all right. Okay, I want to go. Can you go back one slide, Tony?
Oh, absolutely.
Okay. Okay, all right, we're fine. So we hit that one right. I just want to make sure that we were seeing the same thing you were. So you can move up to that next slide if you don't mind.
All right, very good.
Okay, and so a lot of people sit there and say, why does the government allow us to do these sorts of things? And without going through each one of these on an individual basis, the bottom line is any kind of tax, regardless of how minimum, distorts economic behavior. And so the higher the tax, the more the distortion there is. The government and all of us want to use the highest and best use of our property. And this is just one way to accomplish that. So again, it allows for more transactions because it allows people to move property faster and more often than what they traditionally have done if they have to worry about either burdensome taxation or, in the case of a traditional 1031, buying a piece of property that they're not completely in love with. So we can move to the next slide, Tony, if you don't mind.
Sure.
Okay, all right. And so again, when you go through this, if you just, it can be any type of transaction. So Tony, as you click down through that, the seller can have real estate. It can be partnership interests. It can be airplanes, yachts, art, any type of asset that's highly appreciated. And then again, you do not have to go to like-kind property. Once you sell the property, if you want to go from real estate, basically just to put your money into a retirement account or into a fund just for your retirement, that's perfectly legitimate to do. If you want to go from a contract right back into buy a small business, that's perfectly okay to do. There is no restriction here on how you handle the proceeds, what you use the proceeds for after the transaction is done. The money, and I'll repeat this several times, but the money comes to the client, to the seller, unrestricted, unencumbered, and it's theirs to do with. So we can move over to the next slide. Okay, and so there's going to be several parts of this slide, but just to kind of get everybody kind of on board here, we start with the seller. We put a qualified intermediary in between the two, and that we do the installment sale, the 453 sale, at the original price. The money will flow from the seller and then to the buyer. If you want to go ahead and click it down one, Tony. Okay, at the original sales price with no markup. Then, and this is the trick to the whole thing. This is how we get by deferring the tax. We bring in a third-party lender. Now, this is our lender. They have to understand how the transaction works because these are not collateralized loans. So it has to take somebody that really understands this. But they monetize that contract day one. So the day of the closing, the day that the intermediary receives his money, you receive your money. And that will come to you at a stated interest rate. We'll go through that on the next slide, but it's at a 5.7% interest rate, and it flows from the lender to the seller, and then, Tony, go ahead and hit it again, and then to you as the seller, it comes unrestricted. You can use it for any type of business use, including paying down debt. And then the intermediary will set up a fund. And go ahead and go down one more, Tony, if you would. Okay, they'll set up a fund through a payment processor where it automatically, the intermediary makes that monthly payment through the payment processor to the lender each month on the behalf of the seller. So the seller is never involved after the original day of closing. The seller is not involved in this transaction until the end of the contract, which is the 30th year. And we'll explain that on the next slide. So if you want to go over one more. Okay, so we have the buyer and the seller as we would any traditional arrangement. And then we're going to put in a qualified intermediary in between those two. And then when property moves, it's going to move from the seller to the buyer through a title company, just like any other transaction. And then the buyer is going to return 100% of the sales proceeds through the title company to the qualified intermediary. Now, at this point, it looks just like a 1031 exchange. The buyer's completely out of it. The QI is holding the money. Now it starts to look a little bit different because as soon as that qualified intermediary receives the proceeds, he is going to do two things. He is going to set your money, 100% of your money, into an account and guarantee you a 5.7% rate of return on that account, on 100% of your money. and then simultaneously, the third-party lender is going to cut you a check for approximately 93.5% of those original proceeds. And there will be a 6% fixed interest rate on that. Again, that interest rate is not paid by you, it's paid by the qualified intermediary. If you put a pencil to those two numbers, 100% at 5.7% is the gain, 6% of 93.5% is the cost. That comes up pretty close to zero, and that's the reason for those two interest rates. There's no magic formula there. It's just the two rates that came closest to zero. I believe there's a $90 difference per 100,000 to the good on that, and so you receive your money. The qualified intermediary then sets up a payment process where there's 3 escrow accounts: one for the intermediary, one for the seller, that's the funding escrow, and then one to the lender. And every month, the qualified intermediary will drop money into his escrow account. It'll flow through to the seller's escrow account and then to the lender's escrow account. That's how the loan is satisfied. At the end of 30 years, the qualified intermediary will make a balloon payment for the original amount that's owed to the lender. The only thing that you as a seller will see is that once a year you're going to receive a K1, and that K1 will be as close to zero as we can get it. There should be a little bit of money to the good for you on that, but it's going to be as close to zero as we can get it. Because the whole premise behind this concept is this was a no-cost contract to you. It just allows you to defer your taxes. At the end of 30 years, you will have taxes due. There's several theories that come in here. When you talk to our QI, if you're interested in this concept, the QI will tell you that if you're alive, that there's going to be taxes due. If you're not and your estate's closed, the IRS has no place to receive any money from. We take a little bit more conservative approach to that and always assume that you will be here 30 years from now. And so we suggest, although it's not mandatory, that the client sets aside into a special trust. We just call it an heirs trust, an HEIRS trust, an heirs trust, a discounted amount or life insurance, whichever one the client prefers, to make sure that those taxes are, that the money for those taxes will be here 30 years from now. Our job is to make your life easier, and the last thing we want to do is create a negative cash flow for somebody in 30 years, and maybe not for them, but maybe for their heirs who weren't even involved in the original transaction. So Tony, if you'd click down one more time, I think, or maybe 3 or 4 times here. So that shows the money flow going through the escrow accounts. There you go. And then I think click it once more. And then there's the heirs trust that comes up. And so again, that's not a mandatory thing. We just highly suggest it. And there's a multitude of ways to fund that. If you think about it, if you owe $1 million worth of tax and it's not due for 30 years, just at 3% inflation, you should be able to put about 40 cents on the dollar into an investment account and have that money grow back to substantially more than what you were originally going to owe. So this will be the area that people have their most questions on, is how that loan works and anything that surrounds that. I will add in 2 things. I mentioned if the seller is not there in 30 years, what may happen. A lot of people will ask about the QI. What if the QI defaults? This is a non-recourse loan. Everybody will see the legal documents well ahead of time to make sure that they're comfortable with them. That shows that in case of any type of default from the QI, that there is no recourse back to the seller. So once you have your
one of the questions that I have on the screen is this applicable to new construction?
It can be. Now, it depends on how it's set up. We're working with developers because their taxation's just a little bit different. But we think we've got that part worked out. But yes, generally the answer is yes, it will work. But that kind of goes back to the individual and how their corporation's set up.
Sure. And knowing a little that I've participated in some of the 1031s throughout the years, part of that 1031, because of new construction, you'd have to spend all the money up front as you're constructing. What I'm reading here is it's different than the normal 1031 where you have to have the land purchased, you have to have the building already under construction, that type of thing. Is that correct?
Absolutely. You're 100% correct. This is much more flexible.
That's a big deal for most of the people that we work with in the hotel industry, for sure. Right.
Now, for full transparency, we normally are working with people that they're selling the property after it's finished, after it's been built out, but it certainly can be used the way that you've suggested.
Excellent.
Okay, if you would, if we're okay, we can go ahead to the next slide. And a couple of these are just to kind of give you some behind the scenes, the relationship between the intermediary and the lender. The intermediary receives 100% of the cash from the sale of the asset. And what makes this work for them is that they have a 30-year time horizon to make those investments. If you just look at traditionally what the stock market's giving you over a 30-year period, it's between 9 and 11%. They're guaranteeing 5.7. So they feel like they're going to have more than ample money to pay back the loan and to satisfy the monthly payments on that loan during that period. However, once you deviate off of that 30-year period, then the numbers change dramatically, and that's why we use 30 years for the contract. From the lender, because these, I mentioned earlier, these are not collateralized loans, a little bit different concept than what people are used to. The lender's surety inside here is that they dictate, they don't even suggest, they're going to say they dictate how the money is invested. So they know on a monthly basis how much money's there and how much money's coming in. If there's going to be any type of deviance off of what they think they'll be able to do over that 30-year period of time, they can get ahead of it by directing how the QI does his money. They also receive a 6% return through that process that we mentioned before. And then if you move on to the next slide, the lender benefits. Again, this is kind of behind the scenes, but they avoid the risks and costs of a collateral-based lending. If you go back and think about it, most of the time that we have a major upset in the economy, it's because the banks have a discrepancy between their long-term and their short-term assets and liabilities. This solves that problem by having a 30-year placement of the funds. I can go through and read the rest of that for you, but for the most part, that's the main part of why this works, is that we have matched liabilities for a 30-year period of time. And then the next slide is the seller's benefits. This is the one that's really important to you all. Again, we eliminate those major negatives of a 1031 if that's what you're looking at. And let me just talk about for a second how you can use this. We know a lot of people, because this is a new concept, aren't 100% sure that this is, that they want to put all their eggs in one basket by just using this concept. So what we can actually do is we can lay our 1031 plus down as the foundation for a transaction, and then the seller can go to their normal 1031 accommodator and use us for that foundation, lay that 1031, traditional 1031 on top, and then if for whatever reason that traditional one fails, then you still have the tax protection of the 453 that's sitting underneath it. So it's a very, very pliable and flexible concept that's out there. The other things that we have in here... So if I'm understanding,
John, that means if someone had the 45 days to identify and didn't do it on the standard 1031, they could go to the plus year side and have that time limit go away.
Absolutely. I look at it like it's the guy who wears belts and suspenders. You know, it's just you just got double protection in there. The reason we do any of those types of transactions is always because of the tax deferment, and this is a way to guarantee that you're not going to get caught short in case one doesn't work.
That's right. So if they're not able to identify within that 45 days, you know, they won't have a problem.
Correct.
Excellent.
Correct. And then hopefully everybody's had a chance to read through all these, so I won't take you all the time to do that. But the last thing, and we're seeing an awful lot of this right now, we're seeing a lot of people use this as an estate planning tool to move assets out of their estate to the next generation. And of course you want to talk about that on an individual basis, but again, this is a very flexible and very pliable concept out there. The intermediary benefits, I won't dwell on this. They've got 30-year placement of funds. We talked about the 9 to 11%. It insulates them somewhat from economic cycles because they have a long-term investment horizon. It does say that they have a 5% bonus on successful completion of the note servicing. This concept has only been out there for 20 years, so we have not gone through a full 30-year cycle yet. And it's gone through two fine-tunings during that 20 years. But everything, we haven't seen any problems over that 20-year period of time as far as what this looks like on the conclusion. Everything looks like it's right on target. And then the next slide. Okay, this is nothing more than just a time play on money. If you owe $1 today and you can defer paying that for 30 years at a 3% inflation rate, that should be worth about 40 cents on the dollar. If you've got $1 today to invest and you can defer paying the taxes on that dollar, you should have somewhere at a 5% after-tax compound return. You should have approximately $4 to $4.25. So this is nothing more than playing that spread of deferring what you owe today for as long as you can, and then using that money to make money for as long as you can. So there's nothing, like I said, there's nothing magical about the concept. It's what we all do. We all use other people's money, and that seems to be the best way to enhance your own funds. So we're just found a new way to do this.
And probably in more cases than not, the people that are looking for estate planning, or even people that are looking to retire from our business, the hotel business, this sort of fits perfect with them, right? It gives them a place to place the funds. It rests within there, and if they plan it properly, even 30 years from now, even their heirs won't have to worry about it.
If we do it right, and that's what we always try to do, you're exactly correct. That not only will you not have to worry about it today, but the problems will be solved for in the future too.
Sounds like a great plan. I've done a number of 1031s, but I can never say that I've done this. This is absolutely new to me.
Yeah, it's like I said, it's been around for about 20 years, and the reason you haven't heard from it is that the gentleman who invented this is brilliant. He's a Harvard-educated lawyer. He's been practicing real estate law for about 40 years, but he is not a good marketer, and he flies a little bit under the radar screen, and I understand why. But there's no reason for him to. Everything the IRS has seen this. I'm not saying that the IRS loves it, but they certainly haven't disapproved of it. So, and then when we found it, we're marketers. That's why I said earlier, we're not experts in real estate and finance, but we're pretty good marketers. I think I can explain the basic concept, and then what we do is we try to get, if people are interested, we'll get them comfortable with the concept and their advisors, and then if they think they want to move to the next step, we get them in front of the QI and make sure that, again, that everybody's comfortable and they look at the paperwork. And the one thing I will always promise everybody, we will never try to pressure somebody to sign something. This is all about, our job is to educate you and just make sure you know this is a tool that's out there.
Well, and it goes back to what we originally talked about. I mean, if they use this, you know, as nothing more than a safety net for the everyday 1031 Starker exchange, it passes their 45 days. They then would be liable for tax. This allows them to go on to something else to protect themselves from the tax.
Absolutely. Absolutely. So if you want to move to the next slide here, I think it's, yeah, there we go. Just a couple of questions that just generally come up. If the intermediary defaults, we mentioned that there's no risk to the seller because it's it's a limited recourse. Let me explain the limitation. The limitation is if the seller declares bankruptcy. That's where the limitation comes in. You have to declare this in your bankruptcy. However, it will be declared as a loan that's being satisfied by a third party. So there won't be a negative effect to you. Nobody can go in and force the QI to make payments to a third party. The payments will always be made to our lender. That's the one place we've never had it happen, but we know that you know, there's always a day when we may have to face that, and so it's worthwhile to know up front that would have to be declared in a bankruptcy, but it wouldn't negatively affect it. There are also, if something were to happen to the intermediary, and this is the only way that can happen is through a default. The loan would never be satisfied, and what that means to the seller is there would never be taxes due if that happens. Again, we don't want to ever see that happening, but if something does happen to the intermediary, the seller is always safe. And then the next question, I believe, is if something happens to the seller, and we covered that. There you go. The estate will inherit the tax that's due, but again, once the estate's closed, then there's a question of can the IRS collect the money once the estate's closed. The QI will say that they cannot. We take a little bit more conservative approach to that. Where can you find out more about this? Section 453. 453A came in around 1980, where the government said on transactions above $5 million for individuals and $10 million if you're married, that they wanted an interest rate during that installment period paid. Right now it's at 4%. We very seldom see that because most of the time properties inside has multiple partners. But in case of that, we do run the numbers showing that interest rate. We still have never found one that didn't work because of that. Also, a couple other things that people may bring up: form over substance, step transactions, pledge rules, unrelated parties rules. All of those have been satisfied. And then the one that gets asked often is ex post facto, which if what people ask is what if Congress has changed their mind, or what if the tax law has changed? Well, that is covered under the ex post facto rules, which means the government cannot go back in time and change rules. They may say we can't do this in the future, but they can't change what's been done in the past. We already covered why would the lender engage in this, and then we also get a question a lot of times: what's the largest transaction that's happened? Unfortunately, we were not part of this, but in 2004, Boise Cascade and OfficeMax did a transaction for $1.65 billion. So there really is not an upper limit other than our funding of that. The lower limit is we go down to about 500,000, and that's just because anything under that, it just the cost just gets prohibitive for the seller. So we kind of cut it off at about 500. And then the next slide should be on next steps. This is step one, just to kind of get a meeting, to kind of get the flyover of how this works. I would always suggest that if somebody is interested, that they call us. And I think at the end we've got our number, but they call us and then have any advisor or partner that you want on the phone with us. We'll go back through everything, especially that schematic slide, to make sure that everybody understands how the transactions work. And then if it looks like something you want to pursue, then we'll do the same thing and get you in front of the qualified intermediary also. We can also send out a transmittal form, so if you just want to look at some rough numbers on whether or not this is something that would work or how it would work for you, we'd certainly do that. There's no cost for any of this. The only time that you would ever see any type of fee would be at the end if you actually sign documents. And again, we'll never pressure anybody to do that.
And just as a reminder to all our viewers, these slides will be on this network for today. They will be then, this is a broadcast that's being recorded. It will go to Hotel Broker's site. It's hbihotels.com. And on the demand section, all of these slides will be there. John's phone number is there. All the information that you're seeing today will be there in its absolute format that you see it now. You'll be able to really replay this entire slide presentation, but most importantly, if you want to go back and just look at a certain slide, you'll be able to get that slide and look at it along with John's phone number and the company information.
Right, and I think, Tony, there's one more slide in there on, I think with the phone number and yeah, okay. So our number is 844-842-8700. I'm extension 2, or it's Dauble at dwwstrategies.com.
And just to sort of put it more into a format for the hoteliers that are listening, can you maybe go through a recent scenario that you would have had with a hotel person and sort of show how maybe they started thinking as a normal 1031 exchange and then went into the plus factor?
Well, yeah, and I don't want to sound like I'm negative on a traditional 1031 exchange, but it may come across this way a little bit. One of the problems that we're starting to see, well, I guess maybe I can even back up almost a year ago. I was up at the ICSC meeting in New York last year around this time, and I probably picked up 1,500 business cards. And every single person that I talked to this time a year ago said that they were buyers. I did not talk to a single seller. In the last 6 months, all we're doing is talking to sellers. The market's changed. Now, we can all debate maybe why it's changed. Maybe prices are getting a little bit toppy. Maybe people feel like, we're at the end of a bull cycle in the economy. But whatever that reason is, we're seeing an awful lot more sellers. And so since everyone's very familiar with 1031s, that's the road that we traditionally go to. There's nothing wrong with them, except if you're selling property because you think property's too high right now, and you're going into a 1031, you're forcing yourself to buy property that may be at a higher price than what you want to buy. So we're seeing a lot of people looking at this as a way to time the movement in the economy a little bit. Hopefully they'll be right. I don't have a prediction of that. That they think they may be able to buy property cheaper a year to 2 years from now, so they just want to sit on their money, or they just cannot identify the right piece of property during that 45 and 180 day period. So it's really more the constraints of a traditional 1031 that are causing people to look elsewhere than anything actually being wrong with the 1031 itself. So they look at that. We're seeing more and more people that are just walking away from the 1031s, and they think they're just going to do a regular cash transaction. And then when they find that we're available, then that allows them the benefits of the 1031 without the negatives.
That's right. So in the normal sale, and that's probably what we're talking about, far as the hoteliers we're speaking to today. They would go ahead and sell their property. They have really a 30-year period of time to say, okay, we're going to do something with that money, but they can park it certainly for a year or two, and then in a year or two see the perfect place they now want to reinvest their money, and they can do that without having any real trials and tribulations of paying the tax. They've already put it into this investment. They can keep it there for the 30 years, or they can take it and invest it back into another hotel.
Yes. Now, Tony, I see a great question here with several different parts to it. If you want me to get started on that,
go right ahead.
What happens to the 6.5%? So it goes several different places. 0.5% goes to somewhat prime the pump for those escrow accounts for the first month. So 0.5% is used to get the payment started against the loan, and then there is a 1% loan origination fee by the lender. So you could say that there's a 5% commission involved in this. That 5% gets divided, it's not equally, but it gets divided between the qualified intermediary, my firm, and about 3 other firms. So, and I say about because it depends on the transaction, how many other firms are involved. So I would tell somebody that there is truly a 5% commission to this, and then there's a 1.5% that's just kind of overhead. There is an option to terminate early. There's not necessarily a good reason to terminate early. Once people turn around and look at it, we don't talk about it very much. It has to be done on an individual basis, and it is somewhat at the discretion of the QI, because he's the one who commits the money for 30 years. I wasn't sure, Tony, if you can help me on this one. What the timing? I want to make sure I answer that the right way. So whoever wrote that question, if you can give me a little bit more on what you're looking for on that answer. We've seen QI frauds, which result in loss of funds in escrows. What if the QI defaults? Okay. Again, all of the legal documents that you will see before you sign anything. So you'll see them, all of your advisors, your tax attorneys, your CPAs will see these, will all state in there that this is a non-recourse loan. The only way that there's any recourse at all is if you file for bankruptcy. There is no recourse if there's fraud involved with the QI. That's a huge concern based on some things that happened in the last few years, and that's a very legitimate question. So if the QI defaults, if the QI defaults, really it has to be theft, because the lender has complete discretion over how that money's invested. So the only way that they can default is if they just walk away with the money. In that case, you're completely protected. The lender lends money to the seller or to the QI. The lender is lending money to the seller, and the QI is satisfying that loan. So not the lender. So again, the only thing as the seller that you will see on that loan is you will get a K-1 at the end of the year for the funds that came in, credited to you, and the amount that was paid back out to that loan, and we try to get that as close to zero as we can. I always tend to forget this, but there is a $350 a year fee for that K-1. So that there is that ongoing cost. and who's responsible to pay back the principal and interest in the event that the QI fails? No one. It is 100% the QI's responsibility. It never falls back to the seller.
And it goes back to the non-recourse part that they're in, so there is no recourse to them.
Correct. I know that that's for people that haven't dealt with non-recourse loans. I know that that sounds different, but many of us have used non-recourses in the past, and once you've done it, you're comfortable with it. It's just in the beginning, getting comfortable with that concept. And again, whoever sent that in, if you would, on your question about what are the timing, if you could expand on that a little bit, I'll be more than happy to give you an answer. Oh, I'm sorry, I got it right here. When do we start this process? How long does it take to complete the process? So going back to, this is always my suggestion. Anytime you're selling property, the closer you get to closing, the more chaotic things seem to get. So I always suggest that if you're looking at selling something, get comfortable with our concept early, and that is as early as possible. So it seems to be that right now we're looking at an awful lot of January closings. We've got people that are getting comfortable with the concept now, somewhat because we've got that Christmas season where it's hard to get people together to get things done. So we're having an awful lot of meetings now to get people comfortable with the concept so we can get them in front of the QI and get the numbers ran and any legal documents. We do strongly request people to give us at least 2 weeks, if not 3, before closing, because the QI has to have the buyer's advisors sign off on the contract too. Even though the buyer's not involved, just to make sure that there's no questions a year or two down the road, everybody's going to sleep comfortable at night. He wants both sides to be able to sign off on this, and so it's not just the seller's advisors who are looking at this. It's also the buyer's advisors, and so it just takes twice as long to get it done. So hopefully that answered your question. If not, expand on a little bit more. But again, I would start the process as early as possible. And then at a minimum, I would say 2 weeks, probably more like 3. But it really should be done at more ahead of that, just to make sure everybody's comfortable. The last thing we want to do, this whole concept is to make everybody's life better and make them more money. The last thing I want to do is get involved with creating some headaches for some people.
And I'm sure it's just like any 1031. They can't take possession of the money. So, the quicker they're thinking out, the quicker it comes to reality for them.
Yes. Yes.
All right. Well, I certainly want to thank Jon for presenting this to us and coming to us today and giving us another option within the 1031, expanding it so that we can have time and looking at it. So I certainly appreciate Jon coming on with us. Not seeing any other questions, I'll just start to wrap things up a little bit. I don't want anyone to forget to rate this. If you can go to the rate button located at the top of our webcast player, that would be very helpful for us to understand how and what you guys think of these. You can also download a PDF list off our section for hotel investments listed by HBI brokers under the attachment button, and we have some other things there, but in that you can actually look at some of the listings we have, and that button is located at the top of the webcast player. Please share this with any of your colleagues. We would appreciate that. And remember, this and previous Hotel Investor Marketplace webcasts are available for on-demand viewing at hbihotels.com. Before I go, I also want to remind you that we attend a lot of the trade shows, and one of the ones that will be coming up are let's see, at December 4th through the 6th will be the Red Lion Trade Show, as well as the Ellis Conference, January 22nd through the 24th. We would hope everybody registers for our next webcast, which will be December 13th. The webinar will be featuring industry stats presented by Jeff Higley. Jeff is Vice President of Digital Media and Communications for Hotel News Now and STR, so we'll get a lot of STR information December 13th. Jeff does a really good job bringing it to us as they do at all of the conventions. So we hope that you guys register for the next webinar, which will be December 13th. And we hope to see you at all the trade shows. As I said, just the ones coming up will be December 4th through the 6th in Las Vegas for Red Lion, and we'll be at the Ellis Convention January 22nd through the 24th. If you're at any of those, please just stop by and say hi to us. We'd like to meet you and talk to you. Again, thank you for watching our webinar today, and have a great day. And John, thank you for all your help.
Tony, thank you. Hope we did a good job for you.
You did a great job. Thank you.